All right, happy Friday. So we're now in July. Earnings season is coming up. Let's see how things go. I think it's going to be really interesting. But this video is not about that. A question that I get quite often is, when am I closing something? What price do I think I'm going to close at? So I wanted to create a short video talking about that. Buying an asset, deciding whether to buy it and when to buy it is complicated enough. I would say that deciding when to sell something is quite a lot more complicated, actually. So some potential reasons to sell, and just to say, I probably wouldn't sell if just one of these things happened. I would pair it with a lot more research about that potential company. Just to summarize and emphasize, I don't buy stocks at certain levels most of the time, at certain target prices. Quite often, I will research a stock and just try to understand if it seems to be cheap given the rest of the context for that company. So let's look at reason number one. So potential reasons to sell. Now, quite often when I invest in a company, I'll open several positions in that business at various points. This helps me manage my money and my risk. But it could be that I've been buying a lot of something because it was at a good price, or potentially the price of that stock has risen significantly, and now too much of my portfolio is invested, concentrated in that single asset. This is risky for a number of reasons, putting too many eggs in one basket. So quite often I might decide to rebalance if this happens. As a general rule of thumb, I tend to keep my investments in a single asset below 10%. My portfolio has grown quite a lot through the past few months, so I'm safe with most assets at the moment. When this happens, I will close one or more positions in that particular asset, and deciding which one depends on a number of factors, but I'm not going to get into those now. Two, the management team changes for the worse. So investors, particularly those that are new to investment, they underestimate the strength that a good management team gives to a company. And if that management team changes significantly, this is something that I keep an eye on, then I probably would reconsider whether the new leaders or the remaining leaders from the historically successful company are enough to keep it going. As an extreme example, Elon Musk is obviously fairly well known and controversial, but you know that if Elon Musk left Tesla as a business, there would be a huge portion of the share price that would be wiped off from the stock price. Now, that's quite an obvious and popular example. Not everyone knows the leadership team of Volkswagen or other businesses, but it is something, it's obvious with Tesla, it is still important with other businesses. In business companies that are doing well, they create something called a competitive moat. So the idea being that if you had a castle, the analogy being that if you had a castle and you built a big deep moat around it, people would have difficulty breaching the castle walls. Within business, this analogy is used to talk about your potential competitive advantage. So if you've done something so compelling that the barrier to other businesses becoming as competitive as you and stealing your customers is very, very difficult. So for companies like Google, for example, they have so much money and might. Their brand is very well known. When people search for something, they say, go and Google something. Their brand is embedded in our society. On top of that, they have a hell of a lot of money and a lot of smart people. So their search technology is incredibly good. And if you were going to create a competitive product, you would need a lot of money, and still, even then, you potentially wouldn't be successful. Now, if a company's competitive moat has been breached, if their competitive advantage has been lost or eroded, then that's a time to start thinking about whether you should be exiting that business. Examples here, I guess, could include Apple's iPhone specifically. I still think the iPhone is a great product, but when the iPhone was first launched, there was nothing else around like it. And as time has gone on, the cost of technology has dropped so much that people are able to make products that are 80 or 90% as good as an iPhone at a significantly lower cost. So the competitive moat for that product specifically, in terms of hardware at least, has been eroded quite a lot. The fourth point is commoditization of whatever's being sold. So when something new comes along, when there's an innovator that brings something new to the market, it could be a service or a product, quite often that creates, it's kind of a part of point 3, a competitive moat. I don't want to use the same example twice. Apple is another good example. I could imagine an example would be solar panels. So solar panels have been around for a long time, decades. Originally, they weren't very effective. They couldn't capture a large percentage of the sun's energy. They also were very expensive. And as time has gone on, they've become better at doing what they're supposed to do, and they've become cheaper. So companies that were innovators initially, and when there might have been a handful of companies that created solar panels, they had a pretty good competitive edge. Commoditization of solar panels will eventually mean, and I don't think we're there just yet, but it could happen in the next decade or two, it means that we don't think of that thing as innovative at all anymore. It becomes a commodity. The margins on that product become very small because there are lots of people that can create them, and competition drives the prices down. So another thing that has already commoditized are mobile phones. People no longer want mobile phones in most cases. They need mobile phones to be a part of society in an expected way. The fifth thing in this list, and you'll notice a lot of these are business reasons, right? I'm looking at companies, not stock prices, not the actual price point and trying to decide whether I should sell. I'm looking at a business and I'm trying to decide whether something fundamental has changed there. That means that I potentially shouldn't be in that company anymore. Market saturation. So you have a product or a service, and you still have a competitive moat. I guess Google is an example here. Facebook would be another example, but you've saturated the market, so you have a monopoly. But if everyone has a Facebook account, it's very difficult for you to figure out how you're going to grow and make more money. And growth in earnings is a large part of what drives growth in stock prices. So when businesses reach this point, and a lot of the FANGs have reached this point, Netflix, for example, is approaching market saturation, you then need to do something else. You need to become more efficient at what you do, but that can only go so far. Typically, you need to find additional services. So if it becomes obvious that a company hasn't been able to find those additional services or products, that they're going to be in trouble. Apple, as an example, I guess they're close to market saturation in terms of their hardware, so they pivoted a large part of their business to being service oriented, which has worked very well for them. The sixth, it would be what I've called seismic events. So a recent example would be Wirecard. They are probably not coming back from that. So If you had been in the stock at the point of time where this happened, or you had heard rumblings, you might want to get out, and I don't know if you would ever get back in. Other examples include Dieselgate. So Volkswagen, they were cheating on their emissions tests, and they were found out, and that really hammered their stock price, and their stock price remained depressed for a long, long time. So you probably would want to get out, let that thing run its course, which either means the end of that business, or it means that business gets in trouble and has to change fundamentally. And number 7, the fundamentals are just no longer appealing. Now, here by fundamentals, I could mean many things. It might mean that the company has taken on huge amounts of debt, and it's not clear how that debt will be repaid. Or it might be that the PE ratio, the price earnings ratio, has risen to a level that is just no longer sustainable. What else could it mean? I mean, any of the core fundamental reasons. The business doesn't have enough free cash to run itself efficiently. They're not particularly efficient at turning sales into profit. So there's a long list here, but when you buy into a business, you should be checking that the fundamentals are good. And if there's been some kind of degradation in those fundamentals, short term, you might allow them. It all depends on the context. Then you probably want to think about exiting. Now, on top of this, I thought I might also talk about reasons not to sell. And I would say you might want to listen to these, but you don't want any of these individual things to be the reason that you get out of a stock. So the media and analysts are downgrading or shit talking a particular stock. Don't worry about them. If you've done your homework, the media and the analysts usually have some kind of incentive for whatever they're saying. Either they own something, they're shorting something, or they own something, or they want to own something, or they just want to get eyeballs on a particular article. So they pick something and they say something controversial. Everyone else is doing it. And this is where my sheep becomes relevant. Don't be a sheep. Sometimes you do want to get in on momentum, but you're going to need a very good reasons to do that, and you don't want to do it just because everyone else is doing it. Missing on earnings. So I know a lot of people gamble on earnings, and it really is gambling when it comes to earnings. It's very difficult to know how a business is going to fare quarter to quarter, and I will almost never buy just before an earnings report. Sometimes companies miss on earnings. Sometimes they miss on earnings for a couple of quarters, maybe 4 quarters. And that's okay. The stock market might punish them, but you need to look at the company and try to figure out why they might have missed on earnings. Sometimes this is so a company might miss on profit, and the reason for missing on profit is that they poured a huge amount of money into research and development, or marketing, or sales. So they've invested in their business in some way, and that will bear fruit, but it requires some patience. So quarterly earnings reports, they kind of push companies, American companies in particular, to think in the short term. And you want to find companies that are brave enough to not think in the short term, to have their stock price hammered a few times, but that have a good reputation for doing good business. Number 4, executives or other shareholders have sold stock. Now, people pay a lot of attention to this, and I would say, sometimes you do want to pay attention to the fact that the CEO has sold 10% of his stock holding, but more often than not, I would say you don't need to pay attention to it. One of the greats has a quote which makes a lot of sense, which is there are a lot of reasons why someone might sell stock. You're short on cash, there's something nice you want to buy, you're managing your money, you're managing your risk, you were committed to legally or otherwise. There's only one reason to buy stock. You think that stock is going to go up. So largely you can ignore when shareholders sell stock. Individuals sell stock. It's when they buy stock that you want to pay attention. Your position is up several 100%. A lot of the time I see new copiers or people that want to copy, and they ask, are you going to close some of those positions that are massively in the green? You've got positions that are close to or over 100%. And my answer usually is no. And you shouldn't be closing things purely because they're in profit, even if it's a lot of profit. If I think a business is still undervalued, there's no reason for me to close those positions. Maybe I'm rebalancing my risk profile, but it shouldn't be a reason that you sell. And number 6, your position is down. This is controversial in some schools of thought. I know that there are a lot of people that teach stock trading online, and they will say, get rid of your red positions as quickly as possible, or they'll tell you to set thresholds. I wouldn't do that. So I allow some of my positions to run deep in the red. You can't time the market. Sometimes my market timing is bad luck. That means that my positions run a lot more red than I would like to. But if my investment thesis, if my research in that business still holds up, and one day they will recover and those red positions will be massively in profit, I will continue to hold them. If the business is looking bad, though, I will not be afraid to sell them too. So that's about it. I think there are probably a lot more reasons to sell and not to sell that I haven't listed, but top of mind, these are my key reasons. If you have any other questions or reasons that you feel strongly about, I'd love to hear about them. All right, cool. Have a good weekend.